Hello, this is Japanese Economic Review Channel.
Well, welcome to the broadcast, everyone.
Yeah, welcome. Today, for you watching, we are looking at a really bizarre paradox. We're going to explore why the absolute best possible news for global peace next week might actually trigger a massive, brutal stock market sell-off.
I know, it sounds completely counterintuitive, right?
It really does. But we are taking a visual deep dive into the official, newly published statistics to figure it out. Specifically, we're breaking down the data in the Domestic Weekly Outlook for June 8th through June 12th, 2026.
And I have to say, the numbers flashing on the terminal today are just historic.
Oh, absolutely. I mean, the Nikkei 225 has officially touched the unprecedented 68,000 yen milestone. And simultaneously, we're watching this high-stakes, almost violent tug-of-war happening right at the 160 yen to the US dollar mark.
It's an incredibly intense environment across the board.
It is. Okay, let's unpack this. Because seeing the Nikkei hit 68,000 yen is one of those numbers that forces you to just blink a few times.
Yeah, it really doesn't seem real at first glance.
Right, the official data logs that as a 37% jump just since the end of last year.
It is a blistering pace. And, well, if we want to understand the reality of what is driving that 37% surge, we have to look past standard economic fundamentals.
So we're throwing the standard textbook out the window here.
Pretty much, yeah. What's fascinating here is that the metrics in the weekly outlook show an environment completely detached from traditional valuations. This is a market running almost exclusively on FOMO, the fear of missing out.
Ah, the classic FOMO.
Exactly. You have an ocean of institutional and retail capital frantically trying to crowd into a very, very narrow corridor of AI-related equities.
It honestly feels like everyone is terrified of being the only person left standing at the station while the money train leaves.
That's a great way to put it.
But looking at the actual data points in the outlook, the psychology of this FOMO market is creating some really weird contradictions for you to consider.
Oh, definitely.
Take Broadcom, for example. We just saw their May to July AI semiconductor sales forecast. By any objective business standard, the numbers were phenomenal.
Right. They showed undeniable massive expansion.
Yeah. Yet the stock reaction was incredibly underwhelming. It was almost negative simply because it fell short of what the street was whispering.
Yeah, that Broadcom reaction is essentially the Rosetta Stone for understanding this current market cycle.
How so?
Well, when capital floods into a sector based purely on FOMO, it inflates the valuation multiples to a point where the market is pricing in absolute perfection.
So good news just isn't good enough anymore.
Right. If a stock is priced for exponential, world-altering growth, then delivering merely phenomenal growth is suddenly considered a failure.
Wow.
You have to beat the unstated sky-high whisper numbers just to keep the stock price flat. It creates this highly fragile structure where the slightest hint of gravity, like a minor supply chain delay or a slight miss in a quarterly projection, can cause a disproportionately brutal sell-off.
I mean, so we're basically dealing with an environment where great news is just the bare minimum expectation.
Exactly.
Which makes me think, is investing in AI equities right now like trying to jump onto a bullet train that's already moving at 300 kilometers an hour?
It's certainly starting to look that way.
You desperately want to get to the destination,
Yeah.
but you have to wonder when the speed itself becomes the primary risk of derailment. A 37% market jump in 6 months just feels like the wheels are starting to lift off the track.
The momentum is certainly reaching terminal velocity. The official data doesn't necessarily indicate we're staring down the barrel of an immediate 2001-style dot-com bubble burst this week.
Okay, so a total collapse isn't the main fear.
Right, but the structural overheating is undeniable. When an equity market runs this hot, it loses its shock absorbers.
Makes sense.
And the real concern for you watching right now isn't necessarily a spontaneous collapse. It's what happens when this overheated, hypersensitive train hits the very specific structural roadblock scheduled for next week.
Right, because next week's calendar is just littered with heavy obstacles. Let's start with the massive liquidity event outlined in the U.S. market data for June 12th. I'm talking about the mega IPO of SpaceX.
Oh yeah, this is a huge one.
We hear the term IPO all the time, but a company of this sheer size entering the public market creates a totally different kind of gravity, doesn't it?
It really does. It creates a massive liquidity vacuum. To understand the mechanics of this, you have to look at how large institutional investors, like the mutual funds and pension funds that actually move the market, manage their money.
They don't just have endless piles of cash lying around.
Exactly. They operate with strict sector allocations. If they have a mandate to dedicate, say, 20% of their portfolio to the tech sector, and they determine they absolutely must own a cornerstone stake in SpaceX, well, that capital has to be cannibalized from somewhere else.
Meaning they're forced to liquidate their current winners to afford the new ticket.
Precisely. They will systematically sell off their highly profitable positions in companies like NVIDIA, Microsoft, or Meta, simply to drum up the billions in cash needed for this SpaceX offering.
So that pulls a lot of money out of the existing ecosystem.
Right, that introduces intense localized selling pressure across the rest of the tech sector.
Yeah.
But the weekly outlook flags an even larger secondary shockwave.
Oh, what's the secondary wave?
If SpaceX is deemed significant enough to be fast-tracked into the NASDAQ 100 index, the mechanics of the market change entirely.
Because then the passive funds get dragged into the mix whether they want to be or not.
Exactly.
Let's break down how that fast track actually forces the market's hand for the viewers.
Sure. So passive index funds and ETFs are governed by strict, blind algorithms. Their only job is to perfectly mirror the weighting of the NASDAQ 100.
They don't think, they just copy the index.
Right. If the index committee adds SpaceX at, say, a 2% weighting, every single NASDAQ 100 tracking fund in the world must hold exactly 2% of their portfolio in SpaceX by the close of trading on inclusion day.
They don't evaluate the stock, they just execute the math.
Exactly. And to get that cash, these algorithms will simultaneously sell tiny fractions of the other 99 companies in the index. It's a blind, structural capital drain that pulls liquidity out of the broader market and funnels it into a single entity.
That is wild. You have trillions of dollars mindlessly rebalancing at the exact same moment.
It is wild.
And here's where the calendar gets incredibly tricky, because that SpaceX IPO falls on the exact same day, June 12th, as a massive structural event right here in the Japanese market.
A major skew.
Right, the major skew, or special quotation. Now, the major skew happens every quarter, but why does the combination of this specific expiration day and our current overheated market create such a volatile mix?
Well, it really comes down to forced volume. The major skew is the final settlement day for stock index futures and options contracts.
Okay.
Throughout the quarter, institutional players write complex derivative contracts to hedge their portfolios or just speculate on market direction. On June 12th, those contracts expire. Traders are legally forced to make a decision.
They have to either close out their positions entirely or roll them over into the next expiration month.
Exactly. They cannot just sit on their hands.
So it forces everyone onto the trading floor at once.
Yes, and it forces the market makers, the institutions sitting on the other side of these trades, to aggressively buy or sell the underlying stocks to balance their own risk books. This process is known as delta hedging.
Right, and they're doing all this at the exact same time.
Which is the problem. When you inject this kind of mandatory high-volume mechanical trading into a market that is already hyper-reactive from AI FOMO and simultaneously draining liquidity for the SpaceX IPO.
The daily price swings can just become highly erratic.
Highly erratic, exactly.
So we have the AI bullet train, the SpaceX liquidity vacuum, the major C-skew volatility, and if that wasn't enough, the macroeconomic data in the outlook shows the massive shadow of the central banks looming over next week.
The timing really is something.
It is. We're looking at a Bank of Japan monetary policy meeting on the 15th and 16th, immediately followed by the U.S. Federal Open Market Committee, the FOMC, on the 16th and 17th.
And the fundamental narratives heading into both of these meetings are actively shifting.
Let's talk about the BOJ first.
Right. If we look at the BOJ, Governor Ueda's recent rhetoric has taken a noticeably sharper tone. He went on record stating that if underlying inflation risks continue to rise, the BOJ will be forced to discuss actual interest rate hikes.
Wow. For a central bank that has spent decades fighting deflation, publicly floating the idea of consecutive rate hikes is a profound shift in posture.
It really is. The market is pricing in a real possibility of action, or at least highly aggressive forward guidance, next week.
Meanwhile, the data coming out of the U.S. shows a complete narrative inversion. I mean, if we rewind the tape just a few months, the entire market was practically demanding rate cuts.
Oh, absolutely.
But now, looking at the official stats, the expectation of a cut has completely evaporated, and we are back to a place where U.S. rate hikes are somehow a topic of discussion again.
The stickiness of U.S. inflation has certainly forced that discussion. But, the official outlook provides a very important stabilizing context for the U.S. side of the equation.
What's that?
Well, this upcoming FOMC meeting is the very first one under the newly appointed Fed chair, Warsh. And historically speaking, incoming Fed chairs are highly averse to delivering shock and awe policy changes at their inaugural meeting.
Ah, so they want to play it safe.
Exactly. The unwritten rule of central banking is to maintain market stability during a transition. So, while the inflation data might technically justify a hawkish surprise, the institutional reality is that Chair Warsh is far more likely to just observe.
Use his press conference to gently guide market expectations instead.
Right, and avoid any sudden moves that could fracture global liquidity.
Okay, so if we take that central bank dynamic, the BOJ threatening to tighten, and the Fed staying aggressively neutral but keeping rates high, and apply it to the value of our money, we arrive at the most intense battleground in today's broadcast.
The Forex market.
Yes, the Forex market. The domestic weekly outlook projects a massive, elevated trading corridor for the US dollar to the yen next week. They're predicting an absolute floor of 157.60 and a ceiling of 162.00 yen.
And this is where we really have to look past the obvious explanations.
Right.
Because the textbook explanation for a weak yen is the massive interest rate gap between the US and Japan. But the data shows that the interest rate gap alone isn't enough to justify the sheer ferocity of the selling pressure pushing us toward 160.
So what's the missing piece?
To understand the true weight on the yen right now, we have to look at the geopolitical data. Global conflict is acting as a massive invisible tax on the Japanese currency.
And the outlook specifically flags the stalling negotiations between Iran and the U.S., alongside Israel's continued military operations in Lebanon. But how does tension in the Middle East mechanically force the yen down against the dollar on a trading desk here in Tokyo?
It all routes through the energy markets.
Ah, of course.
The tension in the Middle East is holding global crude oil prices at a high, uncomfortable premium. Now, consider Japan's structural reality. It is a highly advanced industrial economy that is incredibly resource poor.
Right, we import almost everything.
Japan imports roughly 90% of its energy needs, and on the global market, oil is exclusively priced and purchased in U.S. dollars.
So high oil prices mean Japan's import bill is just inflating rapidly.
And they can't pay that bill in yen. Every single day, Japanese energy importers are forced to go into the foreign exchange market, dump massive amounts of yen, and buy U.S. dollars just to keep the lights on and the factories running.
Wow, so that's just a constant drain.
It is. This structural, relentless selling pressure significantly widens Japan's trade deficit. And in the Forex market, a widening trade deficit driven by energy costs is a mechanical anchor on the currency.
And the longer the Middle East conflict keeps oil prices elevated, the heavier that anchor becomes.
Precisely.
That makes total logical sense. But here's the piece of the puzzle that I want to push back on. If the structural fundamentals, the stubborn U.S. interest rates, the geopolitical premium on oil, the relentless daily selling by energy importers, if all of that is actively crushing the yen, why hasn't it blown straight through the 160 mark? Why is there this artificial feeling hesitation right at the edge?
Because the market is currently paralyzed by the fear of the Ministry of Finance.
The intervention threat.
Exactly. That hesitation you are seeing isn't economic. It's entirely psychological. Every currency trader in the world knows that the Japanese government considers the 160 mark to be a critical line of defense. The threat of direct intervention is the only thing keeping the speculative dam from bursting.
Let's break down the mechanics of that intervention for you watching. It's not just a press release, right? What actually happens when the Ministry of Finance decides enough is enough?
It is swift and it is brutal. When the MOF decides to intervene, they don't announce it beforehand. They authorize the Bank of Japan to act on their behalf. Suddenly, the BOJ will contact major commercial banks and dump tens of billions of U.S. dollars from Japan's foreign reserves directly into the open market, buying up yen in massive, aggressive blocks.
So if you're betting against the yen.
For a speculative trader who is heavily shorting the yen, getting caught in an intervention means getting instantly liquidated. We're talking about violent multi-yen price swing happening in a matter of minutes.
Wow.
It is a high-stakes game of chicken. And the sheer terror of being caught on the wrong side of that BOJ phone call is acting as a physical ceiling on the dollar.
And the official technical data maps out the boundaries of this game of chicken perfectly.
It does.
The outlook identifies 162 yen as the absolute ceiling. That isn't just a random number, it's a major psychological milestone tracing back to the historic currency levels of July 2024.
Right. And if we break 162, the market assumes the MOF has surrendered and all bets are off.
And on the downside, the projected floor is 157.60.
Yes. That specific level is highly significant because it aligns with the 26-week moving average.
Which is a big deal for technical traders.
Huge. In the world of technical analysis, Half a year of price data acts as a major psychological and algorithmic baseline. It's essentially the medium-term trend line.
So what happens around that line?
As long as the price stays above that 26-week average, trading algorithms are programmed to buy the dip. If the price drops below 157.6 ECO, those same algorithms flip their posture and begin aggressively selling, which would accelerate a yen recovery.
So the currency is physically trapped in this tight 4 yen corridor. It's just bouncing between the fear of a government intervention at the top and algorithmic buying at the bottom.
Exactly.
Which means every single piece of economic data released next week is going to violently slam the currency against that floor or that ceiling.
It's going to be a wild ride.
So let's look at the official timetable. If you are trying to navigate this, what are the exact catalysts that are going to test these boundaries? And honestly, we don't even have to wait for next week. The pressure test starts tonight.
It does. Tonight is arguably the most critical piece of the immediate puzzle. We are getting the U.S. May employment statistics.
The non-farm payrolls.
Yes. Specifically, the market is laser-focused on the non-farm payroll numbers, which the outlook projects at an addition of roughly 85,000 jobs.
But wait, why does a difference of a few thousand jobs in the U.S. matter to the Bank of Japan's intervention strategy?
Because the labor market is the engine of inflation.
Okay.
If the U.S. economy is adding jobs faster than expected, it means corporations are hiring, wages are staying competitive, and Americans have stable paychecks to continue spending.
And that spending drives inflation.
That sustained consumer spending is exactly what keeps inflation sticky. If tonight's non-farm payroll number comes in significantly hotter than 85,000, it instantly validates the Federal Reserve's narrative that interest rates need to stay high for the foreseeable future.
Which pushes the dollar up.
It instantly strengthens the U.S. dollar, which puts immediate brutal pressure right back on that 160 yen ceiling.
And the data gauntlet just accelerates from there. Moving into next week, we have China releasing their Trade and Consumer Price Index data, which serves as the ultimate barometer for broader Asian economic demand.
Very true.
But the true heavyweights drop in the U.S. midweek. We are staring down the U.S. May Consumer Price Index on the 10th, followed immediately by the Producer Price Index on the 11th.
Right. Those two inflation reports are the final definitive data sets before the central banks lock themselves in a room to make their policy decisions.
The CPI tells us what consumers are paying at the register.
And the PPI tells us what it costs factories to produce the goods. If either of those numbers show inflation reaccelerating, the bond market will react violently, yields will spike, and that invisible ceiling capping the U.S. dollar is going to be tested with overwhelming force.
It is a relentless, punishing week of heavy macroeconomic data. It genuinely feels like navigating a minefield for you observing this at home.
It really does.
But looking at the calendar for June 11th, amidst the CPI anxiety and the major SU hedging, there is one non-financial data point that I think we all desperately need.
Oh, what's that?
June 11th officially marks the kickoff of the 2026 FIFA World Cup. So right as the market is hitting peak volatility, the entire globe gets a massive collective distraction.
Ha! It is certainly a welcome psychological break. I imagine more than a few trading desks will have the World Cup running on their secondary monitors while they try to navigate the SpaceX liquidity vacuum.
I have no doubt.
But, before we sign off, I want to leave you watching with a scenario to consider. Something that ties together the geopolitical tension and the FOMO market we explored earlier.
Oh, interesting. Let's hear the theory.
Well, we established that the ongoing geopolitical conflict in the Middle East is a primary pillar supporting high oil prices, which in turn drives the strong dollar and fuels defensive posturing in the equity markets. Now, consider the ultimate curveball. What happens if, over the weekend, the U.S. and Iran suddenly announce a comprehensive, unexpected diplomatic breakthrough and peace agreement?
Well, my immediate instinct is that peace is the ultimate bullish signal.
Natural.
The geopolitical risk premium evaporates, oil prices crash, which solves Japan's import deficit, and the broader stock market just rips higher on pure relief.
Logically, yes. A massive relief rally at the opening bell is almost guaranteed in that scenario. But the weekly outlook data suggests that in our current environment, that spike could actually be fatal. It's the ultimate manifestation of the buy the rumor, sell the news paradox.
Wait, it's fatal.
Think back to the Broadcom example. The market is already priced for perfection. It is heavily overbought on AI momentum. If the absolute best possible news global piece is suddenly announced, there is no more positive narrative left to price in. The uncertainty is gone.
Wait, are you saying the announcement of world peace becomes the exit signal?
Precisely. For the massive institutional fund sitting on 37% gains in the Nikkei, that sudden euphoric retail buying spike on Monday morning provides the perfect high-volume liquidity pool to finally cash out their chips.
Oh, wow. They used the retail relief rally to unload their massive positions.
Yes, the opening bell spike becomes the hard ceiling for the entire quarter, and the long-feared market correction begins not because of a catastrophic failure, but triggered by the absolute best news imaginable.
That is just...
It is a brilliant, terrifying paradox of market psychology to keep in mind as you watch the headlines this weekend.
That is a staggering thought to end on. The idea that the climax of geopolitical good news might actually be the starting gun for a massive financial sell-off. It really highlights how deeply psychological these markets have become. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.